Recording has started. Let's go dissect these guys here. So starting with DXY, because it's DXY. This right here on a daily chart is what we were looking at. I don't remember if I actually said it in any of the calls, but this is the last area where buying is permitted. Based on what I understand, if they're going to buy anything, this is where the area that they should buy it. So seeing price drop below there today really wasn't surprising, to say the least. All right. There were a couple of signatures leaning towards a weaker dollar going into the day. Fundamentally, if you looked at CPI, it was suggesting bullishness for GBP pairs, Euro pairs, and the only way that could be possible is if the XY was weaker. So even though I expected it to do this, I didn't expect it to be tradable unless I was trading before 8 a.m. So I'd be positioned before, like in London, and then that, I think it was 8:30, would give me the volatility I needed to propel my trade. But I just wasn't going to do that. I just wasn't going to lose sleep. So I didn't. So we'll take a look at a couple daily charts just to see what happened. I think we talked about this the last time on the last call, and just kind of scan the daily charts, look at what happened, and then we'll just jump into lower time frame and then dissect. While I'm going through the daily charts, I'm not going to do every single hourly chart. So this is your time to just drop your pair name in the chat, and I'll look at it when we're doing the hourly charts. This I'll dissect this on principle, gold, because this is the trade I took today, and NAS automatically gets a review because it's the pair I trade the most. I think everything here on the hourly chart we have discussed, on a daily chart we discussed in the last call, so there's really no need to reinvent the wheel. The levels are there, which means we talked about them before, and yeah. So just gonna drop straight to hourly chart, and I might need to create an hourly template just for this. I think we had them over here. So we're gonna start with gold. As soon as this loads up. I think this is the second time I'm seeing this hesitate when I'm loading. Maybe it needs a restart. But yeah. Gold H1. Go over how you got that entry on gold at the highs. Yeah. That's what I mean. Yeah. Once I say I'm gonna go over the pair I trade, I'm going to dissect. So I'm just gonna go straight to a naked chart and start with a daily. So first thing, gold is trading higher, right? The last time the daily chart took major lows would have been these lows inside here, this. So on principle, let's stack that. So if we've taken the liquidity below these lows and we're now trading back above the lows, as far as we're concerned, this is a retracement until a high gets rated. So the terms market structure shift and breaking market structure gets passed around a lot. In my view, which is not necessarily the best, it's just my opinion, if I have a high right here and then price runs below a previous high or low, well, it would have been a previous low in this case, I'm looking at the last high before the low gets run and the last low after the low gets run, or the lowest low, let's put it that way, which means that high to that low is a range. If the market is trading higher inside that range, and for visual purposes, I'm gonna do this. if the market is trading inside that range, any highs that get broken inside this box in this run up cannot be termed, well, should not be termed as a market structure break, right? For all we know, this is an underlying bearish market, right? So the narrative is bearish. Context at the moment is retracement inside an underlying bearish market. So this is not a breaking market structure. A breaking market structure means this high gets traded through. Any highs that get rated or traded through between here and here while this is happening has to be a shifted market structure, not a break of market structure. From an understanding perspective, if you want to be methodical, that's a market structure shift. So if I know that this is the range and this is the shift, a retracement inside a range is going to seek imbalances and liquidity. This is the high. Focus on the highest closing up candle. This one, we broke below it, order block candidate. Another one, we broke below it, somewhere over here, possible order block candidate. Big imbalance that takes the low. So again, on principle, that area should highlight where order pairing is going to take place or should take place next. So if the market comes back here, I'm expecting bearishness inside here. So I'm going to tag the low to the high right here. And now I'll give you something that you may already know already. I'm going to take off this line. Just know that this is the low from way over here. Bam. Just in case you're hearing that fan over the other side of the room. It's a hot day. Putting it out there. This right here is the fair value gap, or the CB, whatever you want to call it, or a gap or an imbalance. It's right here, that blue shaded area, or simply order pairing. If this is the range, there are a couple things we know about the range just by looking at it. That's the high of the range. That's the low of the range. And if I grab a fib, and I will pull it from the high to the low, and trying to be as neat as possible. This right here is 50% of the range. No, if that's the range, and this is 50% of the range, and the market is underlyingly bearish because we just broke below major lows and we haven't broken market structure to the upside. That means if I'm going to be interested in seeing another leg or another round of sustained movement lower, I automatically want to see that selling take place up here or start up there, because this is now the premium end of the range. It's just a range. We're using regular range logic. High, low, equilibrium. Now, if this is the premium end of the range, we could take it a step further and say that the high of the fair value gap is premium, low of the fair value gap is discount. So I'm going to go short. I'm not going to sell here and put myself above here. Madness. I'm going to wait for the most premium prices and sell into that. So with that in mind, we're going to drop inside a hourly chart. I don't use a 4-hour chart. No, don't lose sleep over it. I just don't. Hourly chart is clear for me. So this is the premium end of the daily fair value gap, right? I want to tag one more thing. Today is Wednesday, so this is Tuesday, Monday. So the opening price of the week is basically the opening price of this candle. So no need to tag it again. But we want to reference a starting point, right? We want to reference a starting point for what you're anticipating. Meaning, I'm using this color so it stands out when we drop to a lower time frame. That's the opening price of the week right there. Before this candle formed, we would have had all of this price action here. This is the last candle that traded up into the premium end of the imbalance. All right, so listen to this part. This is the candle that traded up into the premium end of the imbalance. If the market is going to start a sustained move lower after this candle closes, we have to trade below this low first. Have to. I'm not saying you can't get a scalp short or an entire bearish day after this. But in order for me to believe or accept that this market is going to really trade lower, I'm going to look at the highest closing up candle that was formed inside the premium end of the imbalance, and I'm going to wait for price to go below it. We don't have to close below it. We just need to trade below it. So we haven't gotten that yet here. Right here, week opens, another bullish candle has formed. We haven't traded below this low as yet. So I cannot use this as a daily bearish order block, which is why I needed to trade below here. So at the very least, I have to entertain the idea that we could still be seeking buy-side liquidity in premium to sell to before I get any kind of movement to the downside. Again, that's our premium portion of the imbalance. All right. So now straight into the hourly chart. No time to waste. We're going to do two things. First thing is we're going to go over to when the imbalance was actually created to look for reference points. The narrative is already clear. We're bearish. We want to sell. Going inside the imbalance gives me a price level from which I could anticipate my entry to form. So scoot, 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 scoot. There. This is the premium end of the imbalance. Inside this imbalance, we have this down candle, this up candle, my bad. I'm going to tag the low end of that up candle. All right, there with that red line. So whenever we get to that red line again in the future over there, just know that this red line and this red line represents the opening to the low of the bearish order block. Right? Something else inside here that we need to talk about. Let's zoom up on it. This is the start of an impulse. Is this a swing high? Yes or no? Just put it in the chat. Y or N? Is this a swing high? Yes, yes. Somebody said yes with a question sign. Okay. By definition, we have the candle in the middle being the highest candle, and it's flanked by two candles with lower highs on the left and the right. Now, if we take a look at all of this, this high or this hourly high was rated right here. And then the next one created displacement. Usually, let's grab an annotation. Usually, when the market is underlyingly bearish, there are four things that happen. An accumulation, a failure swing, an opposing stop hunt, and then my entry model forms. All right. There are many different kinds of entry models that can form afterwards, but this is essentially what you want to see if your bias is underlyingly bearish. You want to see the market accumulate, then create a low, and then you want to see buy side liquidity get taken in that order. When it happens in that order, I can start looking for market structure shifts to happen up here to target that liquidity pool. So if that means market's going to do this And if you want to call it a market maker model, and then this is low risk sell, go right ahead. But at this point in time, after we take this high, I get interested in seeing a market structure shift to go lower. When this happens, let's grab a different color. When this low gets raided, that must be significant for many reasons. Reason number one, after we have this high being formed, inside here, we now have something that has to be significant in the future. This is our dealing range. This is not, well, all right, never mind that part. Too much sauce. Kidding. But this is your dealing range now. So if the dealing range low gets broken, what does that mean? This is now a break in market structure because the range that we're trading in has been broken. So at this point in time, we start expecting the one thing that we all know and love: when markets break out, they will ... Bam. This is what everybody wants to find. Yes, retrace. How many days back do you use Asian range equilibrium for a trade? I was back testing notes in. Kind of tricky question to put in the middle of this, but I guess we'll talk about that later. Yes. So this is the range. This low gets broken right here. This is now a market structure break, while this up here was a market structure shift. So for context and framework, you could have shorted here to target this, and then you exit full position here, or at least majority of the position. You have to take majority of off here, because depending on the delivery here, it can be, and just so we're clear, I'm specifically highlighting how the leg there could be delivered. It could be one big move, at which point we grab a fib. Easy. It could be, at which point we don't need a fib because we know that liquidity is resting above there. So that, and then that. So while we can discuss how to frame a lot of retracement ideas, this part is where you have to do the work. You have to look at the delivery leg here. Look at how it's delivered. Look at where the imbalance is. Look at where the order blocks. If you strictly trade the way I do, then you know what to look for inside here. This leg up could be something like this, which means when we break down here, we start looking for order pairing to get involved here. But again, that part of the price action, or that part of the stalking process, that's where your understanding have to come in. That's the only way I can put it. You have to understand what the delivery looks like, and then you go in the price action and use a methodical if this then that approach. You look at the market just broke the dealing range. I'm expecting a retracement. Where is it likely to retrace to? Are there imbalances? Are there short-term highs? Are there short-term highs in discount? Are there short-term highs in premium? Right? That there's a big difference between the two of those. And then all you have to do is wait. Wait. If you remember EU, look at EU, maybe last week or the week before. We framed what we wanted to see, and I think it took like days to actually come back and form the entry, right? But we digress with a whole lot of this. But yeah, I'll leave that for you to study, clear up. So this is the area in which I'm looking for my short to form. Because of this swing high here, I had this candle's high pegged as a likely area that the market could retrace to. Why? It was formed at 9 a.m. When I trade, I start trading at 8 a.m., which means that if this was the start of New York, right, this is where data manipulation comes in. If this is the start of New York at 7 a.m., 8 a.m. made the high of the day, and then the market tanked. This move up was a Judah swing, which means that it's very likely we had persons being trapped here, going lower. Now, depending on a couple of things, which really aren't necessary right now, we could still have those persons holding on to positions right here. So that high right there, I'm gonna take this off now and pick the actual high of this candle, or the high of the order block, is very likely to see price retracing to it. When it retraces to it, because I'm bearish and the underlying structure is bearish, I don't want to see the market close above it on my analysis time frame. So if my analysis is taken from an hourly chart, I don't want the hourly chart to close above it. It can trade up to it, it can wick above it, but the candle must close below that high. So now that reduces our area of focus a lot. This was 50%, I believe. Inside the red line, the black line at the high, is the order block. Absolute best case scenario, sniper precision, your entry is going to form on the black line. If not, it's going to form inside here. So we're going into the day with the idea that the XY is bearish, gold is likely to rally. But I'm bearish, gold is rallying in a bearish market. If we rally in a bearish market, it means that narrative is bearish, context is market retracing. So all we're going to do is find where it's likely to retrace to and then clap it. So now we jump over to today. Yes, it got there, nothing to lose sleep over. We're going to dissect the price action and start at 7 a.m., 8 a.m. right there. Well, actually, let's do it on a 5-minute chart. So I'm going to go to a 5-minute chart, break down this price action, how I see it. So I could probably use an indicator for this part. Makes life a tad bit easier, but then the levels would be gone. So I think what I can do is ISM. One of these things here is supposed to be ISM. Old age getting to me. Here we go. Load. I think I have a saved version of fair value. Bam. Okay. There we go. Cool. So I had this saved as a inside the indicator, just loaded that on to make life easier. So this is London range. This is when I'm going to be trading. Right? Market opens up 8 a.m. here, Judas down into 8:30 because 8:30 is when the news came out. Actually, 8:25 did it, and then 8 o'clock, 8:30 screamed higher. We can see where it traded to. We know what these lines are for already. This red line is equilibrium of the range, I believe. I don't remember what it's for actually. These two red lines are the order block, opening and low. This is the high that we expect price to possibly trade through, but not close above on an hourly chart. All right, so if we can, not that we need to, real quick switch to our hourly chart, it didn't close above here. So now on M5, if you look at the times I was commenting in the group, it was when this was being formed, and I was saying that gold should be the first one to move lower. It's because gold had already gotten to the point where I don't want to see it going higher. So it's happening, time and price meeting right there. That's the price. This is the time. So I'm not looking for the short to form in London, Asian. I want it to form inside right here, and I want it to form right there. So when that was happening, when I saw this wick come down here, my first thought process is it's going to trade higher and create entry up here. And then I just went to a M1 and the rest took care of itself. So if you know my model, then you know I don't sell into random highs, right? I wait for this high to be rated. When it gets rated, I want a market structure shift and I go short. Depending on how long you've been following me, you'll see my model here. If you don't, then you have more work to do. If you do, congrats. Some other folks will see something else inside here. But this is essentially what I was trading. So now, if you remember how we started the goal analysis, when I was saying, once we have the fair value for more selling, one sec, my daughter. There we go, all good. So if you remember when we started the video, I was saying that when we're looking at gold daily chart, as the market's trading up, just a sec. Daddy duties. So if you remember when we started the gold daily chart, we're looking at, let's just do it since we're here anyway. Gold daily clean. Remember what I was saying about this up candle as it was trading into this fair value gap here. That in order for this to be bearish, there's a certain criteria that must be met, right? Didn't happen here, hasn't happened yet. When I go to this M1 chart, this line represents the same thing that these two lines represent: fair value for more selling. So if it's okay for them to sell inside here, I want to see evidence, proof, market structure being shifted to the downside, which means up candles being formed, going below them, wham. That's you know that song? I don't know it. I heard it in a movie. Wham. So that's what I did. So if you looked at the chart I sent you today on, I think I sent M1, my entries were first one. Let me just see what's in the chat. Yeah, dead fool. Yeah, you're a man of culture, man. Always good to talk to real people at trading. Most persons just, and that's it. My first entry is right here. Oops, right there. Right there. Somehow this line keeps touching what I don't want it to touch. So I wanted to sell the retracement of this up candle in context. So it got me in right there because of spreads. Then the market broke lower. Then my second entry got in on this candle wick. And again, spreads kind of put me somewhere inside here, right? So these are the two entries. Now take a look from an understanding perspective, right? Not chart pattern, just understanding. Fair value for more selling. It's okay for them to sell here. In order for me to see them selling, I want up candles being formed and rated, etc., etc. You know how order blocks look. Something else you'll see inside here, and if my good friend Sean is on the call, he's going to see it too. Moments ago, I said that when we're bearish, the delivery fractal we want to see is that. And grab a little straight line with some red on it. And this is the trade that we want. Take this. Boats are loaded at fair value. That sounds like somebody in the 1v1. So now let's take a look at that fractal right here. Now remember that this right here is going to be your dealing range, and we want to see that low get broken. We're going to be going short inside here to take that liquidity. Then once this gets broken, we anticipate retracements. The retracements and how deep they go will depend on how the delivery was inside the dealing range up and that move down. So now, since I've refreshed the memory on that, let's take a look at what actually happened and put annotations on that make sense. That must be highlighted. Must be. Or if you don't highlight it and you're looking at an actual chart, this is somewhere that you have to keep in mind for many reasons. First one, once we get below here, it's go time. It's breakthrough and never come back, or it's retrace and move lower. That again will be dictated or decided by how the delivery is up here. Buy side liquidity. Did this low take sell side liquidity? Relatively equal lows inside here. Don't want to lose sleep over the definition. That's our dealing range. If that's our dealing range, let's add some technical stuff to that. Bam, right there. Equilibrium coming in right in here. Ideally, I want the market structure shift to take place in premium, so I can go short in premium and trust that the market does not need to retrace to premium. If it's very heavy, once it breaks here, shallow retracements, again, depending on the delivery, and then the market screams low. And there are a couple of things inside here that we may or may not touch on, but let's jump to the important parts. This is the order block from the hourly chart, which means that if, grab an annotation function, guys, bam. If this is the up candle and that's the up candle's open and that's the low, and this is the open to the low area, from a higher time frame perspective, once that happens, we think this and then that. And if you want to get a tad bit more technical, we could say that all of this is one candle. That's the retracement and then lower, right? Now, this or these two lines represents the order block. So when we trade below here, you have to expect a retracement. But where do you expect the retracement to form from? Fair value for more buying, right? Where did they buy before? This order block. So they bought here before, market trades down. Notice we did not touch this order block right here. So they bought and the market moves up. Now, if the market has been screaming higher before, then it retraces. Let's call this order block fair value gap combo, and I'm using air quotes, right? Let's call it that order block fair value gap combo, and persons see more buying here. 90% of persons are buying here, putting their stops down here and praying for this. We are already bearish. We are seeing liquidity being engineered in fair value. That's all we see. So because we know that we just traded below the order block and the retracement is necessary to push lower, unless you're ninja mode, this is not a buy. That's a wait for the sell and then clap it when it comes back up. Stop right here. You might need to zoom out a little bit so everybody can see. Now, remember the logic here and the drawing that we did earlier. When this gets broken here, we want retracement back into the dealing range to go lower. Move down, fails to get back into the dealing range. I would sell here, but not at that price. I would sell again, but not at that price. So now we have liquidity building here and liquidity building here. This is now a trading range. Let's grab that chat quickly. Because yeah, higher time frame is bearish. So now we have a trading range right here. I'm just extending it out to highlight something. That's a trading range, right? If that's a trading range here and here, we know liquidity builds at the high and the low of trading ranges. Liquidity, liquidity. Order block is fair value for more buying. So if they build liquidity in an area where it's okay for them to buy, and somebody buys and put their stops right there, they're gonna buy those sell stops. Buy the market cheap. Where did they get rid of it? Where it's fair value for more selling. Above here, inside the dealing range. Market trades up. Takes care of all of these guys who try to buy early. These guys who try to sell early. Liquidated. Now they can go short again because we have now retraced inside the dealing range. Fair value for more selling is here. Market trades up. As much data as I can. You can look at all of this price action fractal now and dissect it however you want. This context is now a continuation low. 4 conditions or 4 conditions in the market: expansion, retracement, reversals, consolidation, right? This is not a retracement. This is not an expansion. So if it's expanding, where is it going to go to? The liquidity pool. Dora voice. If I had Dora voice, I'd have said, where do we go next? So we're right here. All this just happened and the market's trading low. If the market's trading low after the retracement, we're looking for H1 candle lows. So you could take the markers you have and just find the actual H1 lows on these M1 candles and watch how we trade through them. And that gives you beautiful trade idea. So yeah, I think I did a lot of jawboning on this one. But that's going to be it for this one because it ends in 30 seconds. Yes, I have no intention in getting paid Zoom. That's giving you leverage. So thank you guys for coming out. Hopefully this was helpful. See you in the chat and enjoy the rest of your day. Someone's in the chat.